The US housing market is in crisis mode right now, and many key market metrics and indicators have now crossed a line to make them even worse than in 2008, which was of course the peak of the global financial crisis where home prices were decimated. Now, monthly mortgage payments for an average US household have now reached record highs of $2,632 a month, according to the latest Redfin data. Now, this is 13.9% higher compared to a year ago, and also much higher than the average payments at the beginning of 2023. And according to Black Knight's latest mortgage report, this means that housing affordability has reached a new historic low, as the national payment to income ratio has now reached 38.3%, blasting through the previous high that was set in 2022. This means that US households are now being forced to spend more than they ever have done in recent history on housing costs, squeezing many to the absolute limit. Now, this payment to income ratio percentage is far higher than the 33.9% that was reached during the peak of the global financial crisis, and in fact you'd have to go as far back as the 1980s to find a period of time where the percentage was this high. Now, this surge in housing payments is mainly being caused by an increase in the average 30-year mortgage interest rate, which is now above 7%, but stubborn house prices are also responsible too. Now, house prices just simply are not falling at a fast enough pace to counterbalance the continued rise in interest rates on new 30-year mortgages, and as a result, housing costs continue to rise. Now, according to Redfin, despite being down from the all-time highs set in 2022, the median home sales price is actually up 3.9% year over year. Now, back in 2019, new home buyers were required to spend on average around 18 to 19% of their household income on their mortgage payments for an average price home. With this percentage in 2023 now being double that of 2019, it means that many potential home buyers simply cannot afford to buy a home right now, limiting the demand for homes. It also means that anyone who is being forced to remortgage or even move home for whatever reason may now be priced out of the market, and in many cases may have to actually find a house share or other cohabiting option, or move back in with their parents. And ultimately, this affordability crisis will therefore also drive up the supply of homes onto the market, and when you combine this with the fall in demand, it's going to keep putting more downwards pressure on home prices the higher that this payment to income ratio rises. And it's not like Americans have much money left over in excess savings to make up for this affordability crisis, as Americans are saving just 3.5% of their disposable personal income, which is close to historic lows that we saw in 2022 and not even half of what 2019's personal saving rate was, meaning that on the whole, people are saving far less now compared to pre-pandemic. The growing disparity between the cost of home ownership and the cost of rent is also putting many people off buying a home right now when renting is a more attractive option. Now, since the beginning of 2020, the average monthly rent cost has increased by approximately 28.3%. Meanwhile, homebuyer housing payments have increased by a whopping 97%, so that's close to double what they were in 2020. Now, this disproportionate growth in home ownership payments compared to rent payments means that renting is now much more of an attractive option compared to a few years ago, especially considering that on average rent will be cheaper at $2,052 a month compared to mortgage payments of $2,632 a month. We can also clearly see this being represented in the Mortgage Purchase Applications Index here, in which the demand for mortgages has been rapidly declining in the last couple of years and is now at historic low levels. The demand for mortgages is now even lower than the bottom that we saw in the aftermath of the global financial crisis, which really shows just how weak housing demand is at the moment. And this is just another factor that has been becoming more significant over time and means that home demand is only going to keep declining as this trend continues. Housing inventory levels have been gradually rising over the last couple of years. From the lows of 346k seen in February of 2022, we are now at 669k active listings in the US. And housing inventory levels could be set to rise even more, with the number of new apartments being constructed in 2023 being on track for a new 50-year high of nearly 461,000 units expected to be built. And as you can see from this chart, this is a noticeable increase compared to recent years, while we are simultaneously in one of the weakest markets for buyers due to the housing affordability crisis. And this is backed up by the long-term view of the total number of housing units under construction right now, which aside from in 2022, is the highest it has ever been throughout all of history, even exceeding the peak seen in 2006. Now, we know that there is still a shortage of homes on the market due to the relatively low housing inventory levels that we are still seeing. However, it is certainly worrying to see the sheer volume of housing units that will soon be offloaded onto the housing market. The main concern being that with housing affordability being so poor right now, thanks to the insanely high mortgage rates, the demand is simply not going to be there to soak up this additional supply of housing that home builders will be putting onto the market. Now, this weakness in demand combined with a sharp rise in supply means that home prices are only going to head one way, and that is down. And as a result of the current market conditions, home builder confidence levels have taken a sharp tumble recently and remain far lower than we have seen over the last decade or so. And this index is based on a monthly survey of the main home builders in the US and how confident they are in the market for new single-family homes based on the current conditions. So this clearly shows that these builders are not confident and fairly pessimistic about the future. And when we consider other macroeconomic factors in the economy that also can impact the housing market, it only makes things look even worse for home prices. Now, throughout all of history, the unemployment rate has been strongly correlated with interest rates, except lagging behind by a few years. Now, this means that historically, as interest rates have been raised by the central bank, the unemployment rate has also started to rise several years later. We've just witnessed one of the fastest rate hike cycles in history as the federal funds rate has gone from basically zero in early 2022 to now being at 5.5%, and it might not even be over yet. If history is to keep repeating itself like it always has done, this means that we are likely to see a significant surge in the unemployment rate in the coming years. And when you consider the fact that the unemployment rate is at a historically low level of 3.8% right now, it means that there is still plenty of room for unemployment to increase while still remaining at normal levels we've seen in history. Just looking at the tech sector on its own, we can see that around 164,000 people were laid off in 2022, and in 2023 so far, we've already exceeded that figure at around 235,000 people to date, despite the year not even being over yet. The fact of the matter is that the current market conditions are not favourable for companies, and the cost of borrowing money is extremely high, which makes it harder to get loans for business growth. Consumers are also really struggling right now, with many being squeezed to the absolute limit because of the cost of living and cost of housing crisis, leading to excess savings being depleted and credit card debt to surge. Now, layoffs in 2024 are likely to exceed that of 2023, and with more people not having an income, it leads to many bad things for the housing market. Not only is household income on average weaker, that will lead to an even lower demand for housing, but many of these unemployed people will lose their homes and be forced to sell up as they can no longer keep up with the payments. We're already seeing the number of housing foreclosures uptick slightly from the lows in 2021, and if more people are going to get laid off in the coming years and the unemployment rate starts to rise, then we're going to see this foreclosure data continue to rise as well. If the number of housing foreclosures keeps rising, then this is going to add even more supply onto the market from distressed sellers, which is only going to make the demand to supply in the market even more off balance. On top of all of this going on in the housing market and economy in general, student loan payments are set to restart on the 1st of October, only contributing to the cost of living problem many are facing. The average student loan payment for recent graduates is $284 a month, and this rises to $584 a month for recent graduates who have a master's degree. Now, 37% of first-time home buyers have student loan debt, so this is definitely going to impact a significant portion of one of the main sources of home demand for the market. Now, this is just one more additional factor that is going to be negatively impacting the US housing market going forwards, as it means that homeowners are going to be squeezed financially even more, which may cause more to sell, which will drive up the supply of housing. It also means that future potential buyers have weaker buying power thanks to these extra costs that they are facing each month from now on, further weakening the demand for housing. And another major crisis that is happening in the real estate market right now is related to the commercial real estate sector and the damage that this is causing to the banks. This could be another hurricane to hit the housing market in the coming years, and if you want to learn a bit more about this, then check out my latest video on screen right now. Aside from that, please leave a like on the video if you enjoyed it, that does help out the channel a lot. Also subscribe if you want to see more videos like this in the future, and thanks a lot for watching.